And here he is, the man, the myth, the legend, Bryan. I've got everyone. Everyone is here waiting for you and Steve.
You know what? Just wanted to keep everyone just a little bit late. Actually, ironically, one of my real pet peeves about VCs that are late. So,
good place to start.
A good place to start, exactly. I would like to point out that we still made it within the minute. I would like to believe according to my clock, we were in at noon and like 20 seconds, but I don't know. Everyone here, it's great. We got Liz, welcome. First of all, it's great to have you here. And Jerry, welcome back. Seth, welcome. It's great to have all three of you.
Thanks. It's fun to be here.
Thank you.
Good to be here.
All right. I'm excited for this. Maybe I I would like to believe that all of us are excited, and maybe everyone's like just a little bit nervous.
Or just excited.
I don't know. Maybe I think the reason a little bit nervous is because I think we want to go into some of the things that are not exposed in this founder and investor relationship and founder and investor behavior. I think we want to get into some bad behavior, but we also want to get into some good behavior.
Why are these things not more exposed?
Well,
do we want to? Just to dance around the title of the book
here
or
he comes. Here he comes. Mr. Introduce the subject now.
Right.
Go ahead.
Right. Would the senator provide some context, please yield?
Yeah. Go ahead. Let's do it your way.
Liz and Jerry have written this terrific book called Founder versus Investor, where a founder and investor are talking about their different perspectives on very similar material. And so as a bunch of founders and joined by Oxide investor Seth, I thought it'd be good to talk about. So there you go, context. Sorry, everybody.
All right. Well, yeah, exactly. And also, like, to do this at we're only 2 minutes in, so we're really
can't get that time back.
Yeah, exactly. Right. But yeah, Liz and Jerry, welcome, and Seth as well. So let's start with Steve. I think your question of and Liz, maybe you can take a swing at this. You and Jerry in your book talked about a bunch of things that actually aren't talked about. And why aren't they talked about? Why don't we speak more openly about these things?
That's a great question to start with. I think it's because nobody ever really walks around talking about the worst possible things that could happen in their lives, right? We go through life and we're like, this is the best possible scenario, or here's the outcome that we expect. We don't go into a date saying that we don't clip our toenails. We wait for the person to find that out when we go to sleep with them. And so similarly, I don't think we lead with the bad stuff when we go into a founder and investor relationship.
Yeah, and you all definitely did talk about a bunch of the things, and Liz in particular. You had in particular. There are a bunch of great moments in this book. I loved your sharing is caring section where you're just I'm just going to rattle off all of the things that have happened. That must have felt cathartic to write some of this stuff down.
You should have seen that section before I asked her to take out some of the stuff.
Oh, we should see that section. Where is that? Yeah, thank you. This is this is who was it that accidentally divulged in the Watergate hearings that there was actually a tape recorder in the White House?
What?
Exactly. Now we know what to subpoena. So yeah, Liz, tell me about the origins of that section before Jerry apparently censored the good stuff.
I think he correctly asked for a mildly sanitized version, but it is definitely out there. No, it's a look. The book was cathartic. Jerry and I had been through a situation that neither of us were pleased with, and we decided to step back and say, I wonder if we could make this easier for another founder or another investor to get through. And when we got to this part, I just let it all go, and it was every single nasty little thing that had ever been said to me, whether it was related to the fact that I liked to wear a hat on interviews with people, all the way through to the things that female VCs have said to me, or just, awful sort of misogynist or inappropriate things that male VCs had said to me. And it was nice to put them into print in a way that wasn't going to get me sued.
So the hat one was on the you may have inadvertently mentioned the hat one, because that was, Jerry, is that one that you had her cut? It's like, listen, the hat thing, you and I have talked about this before. Can't wear hats with VCs. You just can't mention that.
I don't think that wouldn't have bothered me. No. I don't remember the hat one, actually.
Yeah, I would. And now I've got I should get a lot of hat related questions. What kind of hat, actually? For, not that I'm withholding judgment, but
I'm a big fan of trucker hats. And yeah, no, there's I don't know if you know the brand Gorin Brothers, but they came out with those line of trucker hats called Animal Farm a few years ago. And the one that I picked for myself was a picture of a lion and it says King on it. And so it's possible that rubbed people the wrong way.
That's, you know what?
A great alpha move.
It is a great alpha move. Yeah, I think, Steve, you and I are both too cowardly to have worn
cowardly lions.
Yeah, exactly. We would not. I did Liz total respect for wearing the King hat. I also love the VC's like, hey, next time, like, I don't know, it's the King hat. We had us all cowering.
Are there other choices?
Right. Okay, so one of the things
there are other choices. Oh, sorry. Go on, Gus.
No, go ahead.
No, there are definitely other choices. There's a rooster, and it says cock on it. I declined to wear that one.
That's
what I'm here for.
That is great. And then, so what are the ones that I actually do want to circle? Because I think that, and maybe it's wrong to start with this as the epicenter, but Liz, I got to believe that this is part of really what informed the book. You had your lead bullet there is that you had a term sheet that was pulled 3 days before closing. And boy, do we feel that one. So could you, first of all, elaborate on our listeners? What is a term sheet? What does it mean to have a signed term sheet? What is closing? And what does it mean? Like, why is that so? That to any founder is a horror story. So, and I got to believe that experience is one of the most scarring that you endured, because it cuts against a lot of the social contract that we have between founders and investors. So I wondered if you might elaborate on that in particular.
Absolutely. So a term sheet is a piece of paper that an investor gives to a founder. And it says, under these set of circumstances, for this amount of money, under these terms, I am going to invest money in your company, and you, the founder, are going to give me back equity, and we are going to go into business together. And if you're lucky, you get one term sheet, and if you're really, really lucky, you can get 2 or 3 or 5. And then once that term sheet is negotiated through with lawyers and signed, for better or for worse, that is the future. And everybody wants to work towards a close. And a close is an investor ultimately wiring you money in the amount that you agreed upon for equity. In this particular case, in this instance, I was working with a very young VC, a first-time VC, a female actually. Yeah, and we were arguing over some of the mechanics of how the wires should go. There were lots of wires happening, and this VC was going to be buying out a lot of my earlier investors, so cleaning up the cap table, cashing them out.
Okay. Interesting.
And we got caught up. Yeah, we got caught up in the decimal points of the mechanics of that. Actually, we were arguing over 2 versus 4 significant digits.
Wow.
And it was crazy. And in the end, the VC and the CFO on the other side got so frustrated that they just decided to walk away.
That's insane. I mean, because that obviously left you in. Was this a lead investor, if you mind me asking, or was this follow-on capital? I mean, not that it matters. It must have been a lead because it's walking away from the term sheet.
Yeah, it'd have been a lead.
It was 100% a lead investor. And it was, it was surprising that that person's reaction was not, hey, I wonder why 2 versus 4 digits is important. But their reaction was, we are just going to walk. And my investors were completely perplexed. They actually placed a call to her boss, one of the managing directors of the firm, and he was just like, well, it is what it is. And I remember what this woman said
It
to
is
me.
what
I
it
said,
is.
it is what it is. And I went to this woman, I said, you've got to be kidding me. Do you see where this leaves us? And she goes, well, I would be happy to call the other investors that you were fundraising from and tell them that you're still a good deal and they should invest in you. It was
Oh, that's
insane.
helpful.
Yeah.
Please
No,
don't.
please don't. Well, yeah, absolutely not. That is, thank you for elucidating the things that we will not do.
It's like having your ex give a recommendation.
Exactly.
Liz, am I remembering
she was not-
correctly? Was this the anecdote where I think one of your investors reached out, but only one when this happened? And you were like, I mean, I'm glad that one person had my back or tried to represent, like, stick up for me in the.
Yes, one person reached out. I can name him if you would like. It was James Hardiman of Data Collective, and he called me and he goes, I'm going to ask you how you're doing, but first, do you and the company need any money? And it was an amazing phone call.
Wow.
Yeah, because he was just like, my fiduciary responsibility is to make sure you guys are not fucked over. And then now I'm going to ask, as your friend, how are you doing? And it was a beautiful phone call in the middle. Yeah, it was amazing.
Love that.
That is amazing.
That's very on brand for James.
Hey,
Yeah,
good
he's
on
a
you,
stand-up
James.
Seriously.
I actually don't know James at all, but I'm glad that we can call
by
him
the
out.
way, part of this, we started with, like, why don't people talk more about the bad and also the good? Because I think there, and one of the things that it feels like is there isn't the right incentive structure to talk more about this stuff.
Well, and also, I think that because really to give James the praise that he's due, you've got to
talk about the bad.
You got to talk about the bad.
Yeah.
You got to talk about, and you don't need to name the other investor, but you got to talk about the fact that, like, this investor walked away from a signed term sheet and 3 days before closing. And I mean, I really think that the first responsibility of venture capital to not do damage in companies they don't invest in. Like that, this feels like this is extremely basic. Oh, but I mean, Liz, that's what was happening to you. This VC was doing damage in a company that she was not investing in. One question for you: do you feel that this issue reflected a lack of conviction? Was this a deal that the firm regretted that they had entered into, and they were looking for an excuse out? Because it just feels. So, I mean, what? Yeah, and I'm sure you were trying to think about all these things. Like, why is this person leaving this agreement?
That's a great question, and one I haven't pondered actually. It is entirely possible. I don't believe it. What I think ended up happening, and I'll take some of the blame for this as I should as CEO. I think I was getting wrapped up in the mechanics, and I also wasn't able to take a step back and say, I wonder why it's starting to become tension filled, and maybe I should ask for some help, perhaps from my current lead. But I was surprised in any case that the MD of this firm and maybe even my current lead couldn't get together and find a way to work things out. Because again, and to your point, we, the company, were going to be left injured, like in a really, really bad state. I can't just start up a fundraise again. I got to wait 6 or 12 months to do that. And she and her firm were going to get to walk away completely clean. It was no skin off their back.
And they walk away anonymous. They walk away without consequence. And this is what the real frustrating asymmetries that exists in, I think, and obviously Seth and Jerry, I want to get your perspective on this as well, because a frustrating asymmetry that exists is it feels like founders, it is never in your interest to talk about the bad behavior of investors. And you're just trying to I'm just trying to live. And whereas I think that when you've got bad behavior from a founder, it often tends to be I think more public, although I definitely want your perspective on that. I am definitely curious if that behavior from a founder can destroy a VC firm in which they do not take investment. I'm like, does the opposite exist? I don't think so, but I would love your take on that. But I think that there's this real asymmetry, and I think that part of what makes this really that it feels like this stuff doesn't get called out because it's not in the founder's interest to do so. But so actually, let me ask this directly, Jerry. In your experience, it sounds like you went through this with. Were you on the cap table when this happened, or this?
I was, yeah. I do think there was something else going on here. I mean,
yeah, interesting. And was it unprecedented?
On people pulling term sheets? No. I mean, I've pulled term sheets. But the reason you pull. So what happens before the term sheet is the founder tells you what the company's doing, how they're doing, what's going on. They give you all this information. You say, great. Based on that information, I'm going to give you a term sheet, and then you give them the term sheet. Then you do some due diligence. They give you the actual documents. They let you inside the company to look and see what's happening. If they lied to you, you pull the term sheet, right? But in this case, nobody lied to anybody, right? So this was completely different. It's perfectly fine to pull a term sheet if what they told you wasn't true, but that wasn't the case here. So I think there was something else going on here. I personally believe, a lot of people, younger VCs who go work for more established firms have much more downside than upside in doing a deal. So they could do a bad deal and then they get fired, or they do a good deal and unless it's a great deal, it's just a deal. So I think some people just can't pull the trigger because they're scared of making a mistake. And this is the kind of thing that kills VCs. I mean, you can't be scared of making a mistake because most of what you do as a VC is a mistake, right? Like, most of the companies you invest in don't become big. So I personally think she just
and
cold feet.
The only way to see career advancing upside is to do something that by nature is contrarian and requires courage.
Yeah. So
that's
if
right.
you don't, but some new VCs, when they're new, they don't, they get hired. They don't know, the people don't know if they have the courage or not. If they don't, they won't last long. And I don't think this one lasted long in that firm. If I remember, Liz, I think she left soon after, right?
Yeah, she got shoved out and put in as the head of one of their companies, and I think it slowly shut down.
Yeah.
So,
I blame this on her.
Not that Liz follows this person's career particularly closely. I'd be clicking reload on LinkedIn every day, being like, "Oh, fired from another CEO position. What's next?" Oh, interesting.
Oh, I take this stuff personally, right? So I actually went on Twitter and called out the firm, which nobody ever does. And I'm like, people should do this. When firms act badly, people should know. But I think I'm the only VC that does that.
God bless you.
It has certainly not made me any friends.
Well, so in that spirit, so we are not going to name a firm, but so Liz, one thing you should know about Oxide is we've had the same experience. So we had a firm walk away we had our lead walk away from a signed term sheet for our Series A. And the firm had, and maybe this has happened in your case as well, and this is why there's just particularly grating, this firm had preempted. So we weren't raising. They preempted. We got to a signed term sheet, and then they walked away putatively over the that we had follow. So they did not like one of the investors that we got to follow. And we're not going to name them either, but suffice it to say, if we name them, you'd be like, what?
Well, so wait, let me ask you a question. So, you started this conversation saying, why don't people talk about these things? Why won't you name them?
Yeah.
I mean, it would do everybody listening a favor, right?
We won't name the firm because I don't want to damage their portfolio companies. I don't want to damage their portfolio. And, but that said, I think that there should absolutely be consequences for it. And I'm hoping we get Seth to expand on this a little bit, because Seth was heroic in all of this. The end Eclipse was heroic in all this. But so they and again they backed out because putatively because they objected to the follow-on capital, actually because it was 2022 and it was a bad market for venture in 2022, and they didn't like the fact that they had gotten over the line. They were having regret, and in particular, they tried to reprice us, which is just unconscionable. And
well, that's just a way of trying to get out of the deal. I mean, that was merely to get to an end that was they wanted to back out. And I think one thing that was, I mean, first of all, just to wind back, like, fascinating book that any founder and any investor, every founder and every investor should read. And I first came across it by way of Invest Like the Best. So great podcast, and you two were on there, and it was more contentious in podcast format than it ended up being in the book. And the book ended up being just like such an amazing long form of going to depth on the unique incentives and some of the constraints on being a venture capitalist, and then the same on being a founder. And I think as Bryan and I talked about a lot, like, it was amazing how much you both agreed on, which may be an indictment on of the VC community and then the founder community. But in this particular case, one of the things we found ourselves spending a bunch of time on is trying to understand partnership dynamics.
Yeah.
Because you'll have a partner who is very spun up on a company. And I mean, Liz, you've definitely hit on this a bunch, but this only gets over the line. And a fundraise only happens when a partnership is in agreement. Most firms are consensus driven and require that you have got consensus in the firm. And in this particular case, you had a partner who was very excited about the deal and kind of like tepidly grabbed his tepid partnership over the line, only to feel more and more pressure, probably between term sheet and what would have been close, and resistance. And they inevitably caved to the pressure inside the firm and backed out.
Foolishly sent us an email explaining that they were backing out because of the investor in the syndicate. Like, I mean, I guess, like, happy that you guys are so incompetent, because, Jerry, to your point, they could have done much more damage to the company if they're like, oh, we discovered something in diligence that we can't even talk about. That's just too horrific to mention. That would have been really bad. But they did. I guess they didn't do that. And
what was good is they said, we don't like this really good investor.
This investor whose feelings were really hurt, by the way. They were like, we've co-invested with them in a lot of deals, and I always thought we were really like we don't have sharp elbows. We thought, we're like, it's not you, it's the lack of conviction. Jerry, I will say this: so in terms of, and again, we name them in private. And
I'm not trying to put you on the spot. I'm just trying to point out, like, the reason people don't talk about this stuff is because everything's interconnected, right? So
yes.
You talk about it, like, this whole book came about because after this problem that Liz had with one of her existing investors, I was just pissed off. I wrote a blog post called "Your Board of Directors is Probably Going to Fire You," which hit like the top of Hacker News, and Liz called me. She's like, "Is this about me?" I'm like, "Yep," and she said, why don't people write this stuff? Why didn't you tell me this beforehand? I'm like, well, I did. This is actually an email I send to founders. But it was, I actually think the blog post was really, like, balanced, and it was, I think it was, I stand by it. But I got a lot of emails from VCs being like, dude, you can't say that. You can't tell people this stuff, because then they're not going to trust us. They're going to treat us differently. It's not going to work. And I was like, dude, if you want it to work, then make it work. It works for me. So I don't know. I think just speaking out can sometimes be a problem because people don't want to change the status quo. And so Liz and I decided, we're like, you know what? We've got nothing to lose, which of course is never true. Let's write this book as if we, and just tell people what we think. It's not so bad, but we didn't want to go in and just agree with each other like everybody always pretends to do. We wanted to tell people what it was really like.
Well, and I think, as Steve says, you did people an enormous service by doing that. And I would say the other thing I would say in terms of, and there was clearly ultimately consequence for the VC that walked away from your signed term sheet. I will say one thing, that one of the many interesting moments along the journey, we were talking to another investor, actually looking at our Series B, I think, at that point, and we were retelling the story. And VC's like, wait a minute, can I guess the firm? like, you guys haven't named the firm, but if I guess the firm correctly, will you let me know? And Steve and I are like, obviously, we're going to name the firm anyway. So yeah, of course, we're happy to let you guess. And one of the other partners had gone to the bathroom while we were talking to her. And she had a guess that was incorrect. And then she had a second guess that was correct. And Steve and I did, I mean, like, I think I let out the same whoop when the Broncos scored the game-winning field goal yesterday. I mean, you and I acted like we'd just seen a buzzer beater. I mean, it was impressive. It was impressive. And he came like storming out of the bathroom, like, what did I miss? Like, what's going on out here? And he had like, he's like, did someone like make a shot into the trash can from like across the room?
Right.
And it was like, he had a good intuition, like, yeah, that would also be the kind of thing that would get us held up. But anyway, that was really interesting. And I think it said, like, this is not the first time this has happened. And so this is where I kind of want to get you in on, and then Jerry, I want to get back to the points you're raising, but I do want to call out in the spirit of calling out James, Seth, when that happened, you all were absolutely heroic because the company was left really in the lurch. They had preempted us. They had distorted our process. We'd gone around, we'd shopped ourselves on this term sheet. Like we were in a real pickle. And Seth, what was your kind of thought process when that whole thing went down?
Frustrated. It was like it was that aberration in June of 2022 when the market freaked out. Everybody pulled back, and then we kind of got back to business within 6 weeks. So, obviously super frustrating. I think like, once I'm involved though, I'm all in, right? And I love this company, and I just have so much conviction, have so much conviction in what it can be. And so there was like never a moment hesitation for me, and frankly, never a moment's hesitation for my partnership either. That was the thing to do. And so like, listen, I think it's like, there's a lot of bad behavior across the ecosystem, but there's a lot of good behavior too. And, my mindset on this is really like, whenever there's bad behavior from the venture ecosystem, it's just another opportunity for, myself and Eclipse in a business of selling a commodity, capital, to differentiate ourselves by being, full-throated in our conviction behind the companies that we work with. And when there's a challenge, like that's really the litmus test of a good board and a good set of investors on your cap table. It's easy to be along for the ride when everything's up and to the right. The whole reason for us to be there as partners and supporters is when there are those types of moments. So for me, it was just like, hey, it's an opportunity for us to lean in and support these two guys and the wonderful company that they're building. And boy, has that yielded dividends for us.
Yeah, and I think that so Seth, just Liz, to kind of what James did for you, it was very similar conversation. Right? First of all, like, how are you two? And by the way, like, let's lead this round to the best of our ability. Which, by the way, we're already tapped out of our. I mean, we're not going to be able to lead very much, so it's gonna. But we can at least take over the round, which was huge.
Yeah, I mean, it allowed us just to
get also just like a lot of capital that wanted to come into the business. Yes. And so it was like a pretty easy, it's like not all altruistic either, right? Like we have a large existing investment in the business. Like I still believe deeply in the business's potential at the time. And there was a lot of capital that wanted to come in at a fair price, and to let that kind of stymie, going back to like Liz's point in the book, right? We would have been kind of back to the starting blocks for 6-12 months, and we weren't in a cash position to go do that. And so it was a good opportunity to go catalyze, interested capital into the business and be able to continue on our journey.
Yeah. So, and actually, Liz, this question for you, like, how has this informed how you vet investors? I mean, what do you, because I know that, when I look at our process, we got obviously extremely lucky, and we definitely did reference checking and so on.
Well, I do want to point out in the reference checks on Eclipse, specifically, we talked to a couple of their customers, and I mean, it's kind of like hiring. If someone is providing you references as they are trying to get hired at a company, like there is not an incentive structure for people to give negative feedback necessarily, but you will. But in this particular case, you had portfolio companies that were like just able to give us like the real hard truths about their relationships.
Have we told Seth about these calls? Because
we're doing it now.
No, but Seth, one thing you should know is one of these portcos is like, wow, you guys raised a $20 million seed. Wow. Have you thought about just splitting it and running for your lives? And we're like, definitely happened.
Literally joking.
I mean, it's like, no, like seriously, like you could, that's a lot of money. You could actually you could live on the lam for a long time. Like, no, yeah, not thought about that.
No, not doing that.
That's
Talking to one of
the catch everything in the reference checks. Huh?
Talking to one of their portfolio companies, he said, look, they are good investors when times are good, and kind of gave some examples of good times, and then said, but they are great investors when times are tough, and then gave some examples of difficult boardroom situations where you had people with different incentives that were trying to do things that were not in the best long-term interest of the company, and that Eclipse stood up and said, like if you just double down around the long-term vision of the company, and that was super informative and helpful. But I think where you're going with it is like we did not do more than a couple of reference checks, but those definitely checked out. I know, Liz, you talked about making sure to take time, which is really hard when you are in the rush to get to a term sheet. And then you get these things put on the term sheet, like, oh, this explodes Sunday night at 5 p.m. You get handed it, Friday at 1 p.m. And you can feel panicked, like I've got to take this or else. But to actually buy yourself the time to go do proper reference checking and just getting to know the investor better is both hard but super important. It sounds like over time you've gone much more in depth on that.
I have the mistake that I made in the first situation where the term sheet walked is actually an existing investor on my cap table. This woman used to report into him when he ran a public company. And so in my eyes, I was like, oh, she's going to be great. It's great. It's already vetted. And that was an incorrect assumption. Now I actually start vetting before, so I create my list and I go through my process, but before I even have an email going out, I am back channeling to various portfolio companies that belong to each of the investors to find out what's going on. And when I ask VCs for references, I also ask for one that is currently contentious, so that I can hear how conflict is happening today. And a good VC will say, okay, here's the situation, here's what I think they're going to say, here's what I'm going to say about it, but please go talk to them. So I've moved that process on up. And then in terms of your point about a term sheet exploding, when a term sheet has been issued to a founder, I think the number one mistake that founders make is they rush. And in fact, that's when the founder has maximum power, which is the VC doesn't want to pull the term sheet. The VC really wants to do the deal. They definitely don't want you shopping it. And so a founder can take their time. A founder can be methodical. A founder can think through everything. So long as the founder is working towards a deal in good faith, that VC, I believe, isn't going to go anywhere.
Jerry, can I ask you, because this is something when we were raising our seed that we fretted over very, very deeply. We were extremely concerned, and people who were in the industry were like, no.
Let's negotiate that away.
Negotiate it away and just say like, no, we should go to dinner together next week. We got to get to know each other because and just for the broader audience, the reason one might give a term sheet on a Friday and have an exploding clause on, say, Sunday night at 5 p.m. is because firms typically meet as a partnership on Mondays. And if there are other investors that are interested in investing in a company's round, if they are not already there, will certainly have to have one more partnership meeting to be able to get all the way to a term sheet. And with this clause, if a founder is convinced that it truly could go away Sunday night at 5 p.m., then what you do is you tell all these other investors, hey, you have until Friday night or Saturday or Sunday to let us know if you guys would like to provide a competitive term sheet. And, most other firms are like, we can't do that. We would need at least until Monday. So it can put founders in this trapped position of not being able to understand what the other market opportunities are out there. Jerry, why does this clause remain?
Well, it doesn't usually. I mean, I've never put one in, but I think it's fair enough. Well, I mean, look, I've never given a term sheet where I didn't know they were going to say yes already.
Oh, interesting.
That's a really important point.
Yeah, right. I mean, I think this is Seth and I are on the same page here. You can't compete on price. That's you can't win if you compete on price, right? This is it's the winner's curse in auction theory. If you got 10 people bidding on a company, the highest bidder has by definition overbid. So if you're competing on price, you've already lost. So you need to get in there and convince the founder that you're the right partner. And I mean, hopefully that's because you are the right partner. And then you figure out what the term sheet should look like. You give them the term sheet and you expect them to say yes. And if they don't say yes, then as an investor, I feel like I've dodged a bullet because this isn't somebody who wants to partner with me.
Interesting.
I think that's right. And like, it goes both ways, right? When I was early, in my career at Eclipse, a young partner, and I tried to preempt a company, and the founder said, "Hey, like I think I can get a better price essentially from the market." It's like, great. And he went out and fundraised openly in the open market and couldn't get any offers, and came back to me after having run down the runway quite a bit, saying, "Hey, does that deal still stand?" I said, "Okay, yeah, but I'm going to go take this through my partnership, but let's shake hands that you're going to take these terms after I go put myself on the line to go do this deal." And he said, yes, of course. I went out, did the work, worked over the weekend, did all the work to get my whole partnership aligned, got approval to do the deal, gave him a term sheet. He went and shopped that term sheet, took a higher offer.
Oh,
so like this stuff happens across the board. And I think the mentality there is that's not the right partnership for me. If those are the cards that are going to be shown, I don't think it makes sense to go. Like, we could sit here and talk about all the scenarios where the worst of this ecosystem comes to fruition. And I love the book because it helps founders guard themselves against those things and create leverage in pivotal moments where you can make sure that you're protected yourself and your life's work appropriately. But the better thing is to talk about the outlier upsides. And when this stuff goes right, that's the greatness, that's the magic, that's the wonderful aspect of what we do. And I think Jerry's point around like never giving a term sheet that he didn't know was going to be taken, that's the abundance mentality where you've done the work on the front end with a team. That's like, Jerry, I'm sure it's a lot of early stage investing, right? So they've cast their ship into the abyss. Like, failure is almost certain. The odds are so stacked against them, and yet they've found somebody, Jerry, who believes in what they're doing, has a unique, perspective, a unique ability to lift the slope of attack to improve their odds of success. And like they've already decided pre-term sheet through the process that he's run that they're going to go work together. And that's the way that I like to run it too. If you're like, I have a CRO at a company that says if you don't know who's going to get the right response or the winning response to the RFP, and it's not you don't know that you're submitting the term sheet and it's going to be accepted, like, it's not you. And I feel like that's the right way to approach this early stage investing dynamic.
Yeah, and the other thing, as an investor, and sorry to any the founders or would-be founders here, is there are plenty of fish in the sea. If somebody doesn't want to work with you, move on. I mean, really seriously, like, every VC says they see a couple thousand deals a year, and that's true. And there's always other deals. There's nothing worse than being like, I have to be in this deal, and then it being an awful relationship, especially, and I invest usually first check. So it's a long relationship. I mean, Liz and I have worked together now for 20 years, I think.
Yeah. And I think from a founder perspective, there are many fewer fish in the sea because there are, especially, when you're, because you're going to be off thesis for a bunch of, there are only so many firms where you're going to be on stage, on thesis, where there's going to be a fit. I think that, one of the early pieces of advice that we got that I know that you and I, Steve, went back to over and over again is don't overly fixate on the economics of the deal. That all these other aspects, way more important. And I think, Seth, this dovetails to what you're saying as well, that it's way more important to gear the company to success than it is like you can get in your own way on the economics. And I feel that has been certainly, I mean, so when we've always been looking, and actually it's funny because, I mean, how many times, Steve, have we been grateful that firm walked away from that signed term sheet and the Series A, because they were actually the wrong investors. And we are so much more grateful for our existing cap table.
Well, I mean, to the point where when we faced, a decision that we may have to make, in a couple of days, we talked about it a bunch. We're like, well, how much do we want to buy ourselves some room to close out other conversations, make sure we feel comfortable with our investor? And, I think we had the conversation just like, this is the right investor. I mean, Jared, to your point, like the term sheet that was extended was, I think, extended with high confidence, and we took it, and it was the best decision we ever made, because we had a investor that wanted to be a long-term investor in a project that was going to be measured in a decade plus, not a year or two.
We are in danger of overthinking things. So, Jerry, one of the things that we came back to Eclipse with is we were concerned that they were taking advantage of us in the event of Steve's untimely death. And do you remember this? They're just like, and I remember Leo being like, "What are you talking about? Steve, is he ill? Does he have some why would we be talking about Steve dying?" Well, no, but just in the event that Steve's dying, it seems like you would have reading this verbiage, and Leo was just like, "What? Where are we? Where are we right now? Like, what? You guys are very you're way off the track here. Yeah, fine, we'll change the verbiage to Can we keep Steve alive? Why are you talking about Steve?" So, Seth, I'd like to apologize to both you and Leor and the firm.
You guys overthink something. Come on. I do like the, Liz says something in the book about valuation, and there was comments in there about partners over price. I think it was either these are my words or hers. Price can be a rounding error in the long term, but integrity you find out pretty quickly. And I want to go back to the moment where your guys' term sheet was pulled, because there was a discussion inside my partnership of okay, should we match these terms, or should it be at a lower price? And what we quickly came to was to the point you just made, Steve, of this project is measured in decades, right? The vision for this company is so big. You guys are gonna be working on it for many, many, many years to come. And at the moment when you guys were licking your wounds from having a term sheet pulled, the discussion literally in our partnership was worst possible time for the future of this relationship to go get, a penny wise and pound foolish on price.
Totally.
And I think that mentality has to go both ways, though. There's too many cases where founders are optimizing for 10, 15, 20% at the Series A or the Series B, when you literally have a decade plus to go to build anything of value.
Yeah, totally. Oh, and hopefully we've hit that balance on our side too, Seth, because I feel the same way, and we've always value. It's Seth, you had a line for me, and I can't even remember. I don't think we were talking about me, but we may have been. But you had a line that has really stuck with me about it's got to be company over ego, because especially when you're negotiating something, it's your own ego can really get in the way, and you can just on anything, right? It's just natural for our own sense of self to get in the way. And what's all of us together have to be thinking about, we are all, I mean, the thing that ultimately bonds founder and investor, we are trying to build a successful company together. And all of us have to put the company over the ego, which Seth, I've thought about that a lot.
Yeah, most great things come from putting the we before the me, which is challenging when it's your company, right? It's your life's work. And I'd be curious, actually, Liz, how you think about founding of a company and board member fiduciary. There's some comments in the book around that type of dynamic, and certainly the forward from Sandy Lerner kind of speaks to some of these dynamics as well. Be curious how you think about that.
Yeah, she's great. She's fantastic. We were so lucky that she agreed to write that. The exact quote referencing on valuation actually came from Godfrey Sullivan, the former CEO of Splunk, who said, if you do everything right at the end of the day, everything is a rounding error. And that's somebody who's been through it before at multiple companies, and I take that to heart. And so when I started, look, I'm pretty long in the tooth now. I'm on my third venture-backed company. but I learned something new on every single fundraise. And so for this company that I started called Sand Garden back in September of last year, valuation was the least of my worries. I was focused on control. I was focused on how co-founders would vote together or be unable to vote together to keep control. I was focused on board composition. I was focused on thresholds that the preferred that investors had that would have limited my ability to sell the company, quote unquote, earlier if I thought it was the best thing for the company. So it was around my ability to control the future of the company as opposed to some future arbitrary value that may or may not ever come to be. And another thing actually that came up with this company was that I insisted on naming board members in particular and actually having control. So if a board member, Seth, if you were to die, for example, and your firm had to appoint a new partner to my board, that I would have control over who that partner would be, because we're in a relationship and I didn't want a venture capital firm to arbitrarily be able to put a partner in place with whom I had maybe a negative relationship or maybe not the best working one.
Yeah, interesting. Okay, so on the board, okay, one thing I'm definitely curious about, because you, I think the times that I laughed out loud at the book is when you talk about, you go just open loop on board meetings that are not useful. We have, I think, always had the luxury at Oxide of having a really, honestly useful board, in part because, I mean, Seth, I think you and I and Steve all got a chance to learn from one of the all-time great board members in the history of Silicon Valley, Pierre Lamond. Liz, one question for you is: have your feelings about board meetings moderated at all? And then Seth, I want to be sure to get to you to talk about how, and Jerry, maybe what you've seen in terms of how boards can be effective, because I do think that, and I think we've been spoiled by having just an outrageously good board in that regard. But Liz, what do board meetings look like? Have you satisfied your life's ambition of the once per year board meeting?
In fact, once per year board meeting is indeed codified in my Sand Garden docs.
Yes.
And I assume that will change on my Series A. But I do not have board meetings today. My board meetings consist of me proactively reaching out to people who are experts in a particular area and getting their opinion. So I am still a huge fan of my shadow board, which is people that are good at one thing and exactly one thing and helping me, as opposed to these, contrived quarterly updates where we go through stuff and it's just spinning our wheels.
But the company's at the seed stage right now?
Yes, we're at the seed stage.
Yeah.
Yep.
Yeah, I mean, that makes sense. Like, so what do you do at like a seed stage board meeting, right? That's the kind of like a waste of the founder's time, so to speak.
I didn't know that it was a waste of our time. I always felt like, here's what I always felt was very productive about the board meetings, even at those early stages, were because Seth, Lior had a line for us that, or for me actually, that was really interesting. He's like, at Eclipse, the companies that have not been successes are the ones that didn't listen. And it's really important that and I thought that was interesting. I mean, it was like, okay, I think I get the message. I think who this message is directed at, only me. So I got you. But it was also like really important to me, like existentially important, that you listen. And so I think that one, board meetings gave a cadence for that. It also just gave us a cadence to have our own, present our own narrative for where are we. I mean, we Steve, you and I had always vowed to not do make work for board meetings, which I think
that was it. We used it to say, let's sort of make sure the information that we have internally for the company in terms of priorities, risks, what's changed, that we use those as just a point of reorganization or organization to kind of get your thoughts together. And you have to be able to distill it to folks that don't have as much context, and are obviously, going from, a number of different companies and board meetings. So they've got to be able to like page it in quickly and then be able to have, hopefully productive conversation about it. And then, and I think the things that we found valuable is that, Pierre would come in having read the materials cover to cover and would have only a handful of questions. And most of the time those were material and on point and merited discussion.
So Seth, you obviously got to be in a lot of board meetings with this guy and over a bunch of different companies. What is your perspective on how to be a productive board member?
Number one, read the material. Amazing. I'm on 12 boards right now. It's amazing how many people don't read the material. I think in general, like just the bar is so low when it comes to investors and VCs. Yeah. Like it's like that you are the average of the 5 people you spend the most time with. I'm fortunate enough to have a bunch of partners that really aren't VCs in the traditional sense, and I really don't spend a whole lot of time around other VCs because I think like the bar is fairly low. So read the material. I think like my comment on the seed stage is like most seed stage companies are raising a couple $1 million. They're doing the work to understand like what product to build for what subset of customer. They're iterating, right? It's the idea maze of getting to a place where you've got a product to deploying or distributing and real traction, that sort of thing. And the plan can change week to week, month to month. And so like having a quarterly board meeting, you guys weren't that, right? You raised $25 million right out of the gate. You knew exactly what you wanted to go
20,
do.
But
you hit the run. You hit 20. You hit the ground running. It was into the meat of it very, very quickly. And there were some very important decisions across all aspects of the business made, in the first 6 to 12 months of the startup. And any one of those things, think like how much of the stack do you want to go develop against? Like which partnerships, from a component perspective, do you bring on? How do you think about, what is your process for hiring? Like just there were so many fundamental things that you guys did in the early days that have set the company up for where it is today, that if you had gotten those things wrong, we might be telling a different story here. And so, like those board meetings were pretty meat and potatoes from the jump. I think Pierre set the bar for me in a lot of ways because like he didn't come in and pontificate or be prescriptive, or at least he most of the time he didn't. He came in and he was prepared. He asked a couple good questions. He pushed you guys' thinking. I think you got a lot out of it, and hopefully he was able to help you avoid stepping in a pitfall or two along the way.
Absolutely. Jerry, do you know Pierre? Have you ever co-invested with Pierre?
No, I don't think so. No.
Pierre. So Pierre was at Fairchild back in the day. He got a very funny story about hiring Andy Grove at Fairchild and grading Andy Grove's assignment harshly, and Andy Grove harboring a resentment about that years and years and years and years later. But Pierre was with founder of NatSemi, and then was on that kind of that founding team, and then was with Don Valentine at Sequoia for many years, and at Khosla, and then Clips. So Pierre has just seen it all. And if you're doing the math, I think just celebrated his 95th, right, Seth?
Well, I would say anyone who thinks they're long in the tooth when it comes to startups, Pierre's at 95. He's still making angel investments. So we all have a long way to go.
And Pierre would always call us he's like, well, listen, young man. I'm like, I'm years old. Why are we? Okay, you know what? Fine. But I think that Jerry, if you ever, Pierre was famous for being a diligent board member and really was a template, I think, for us. But so, Jerry, what have you seen in terms of how boards can be productive from the investor perspective?
So that's not the question I'm going to answer. Look, boards are great when your company's doing well. It's everybody's happy. The board's going to support the founders because it's going great. It's when you hit bumps that the relationship can get contentious, obviously. And I think it's the thing that founders forget is they work for the board, right? They are employees of the company and work for the board. They may think that the company's their baby, but once you take somebody else's money, you work for them. And if you treat your board as partners as opposed to your bosses, then you can get yourself in trouble. So, the email, the blog post that started the book, beforehand, basically said, look, you as the CEO, as the founder, you run your board. You are there to the VCs have to be there, right? That's part of their job. They have to see what the company's doing. It's a fiduciary duty, and they're there to make sure that their investment is going where you told them it was going to go. They're not there to provide you with help. They will provide you with help, maybe, but that's not really their job, right? They gave you the money, you do the job. If they could do your job, they would do it, right? There's much more money in being a founder than there is in being a VC. You look at the Forbes 400, how many VCs are in the Forbes 400? It's like there's a handful. How many people who are entrepreneurs or children of entrepreneurs or ex-wives of entrepreneurs? It's a huge proportion of the list, right? So VCs can't run your company. If they could run your company, they would go run a company. So you can't expect them to be the ones to help you run your company. They do have good advice sometimes, but they'll give you the advice whether or not they're in the board meeting. Your board meeting should be you telling people what they need to know to do their fiduciary duty. If you want their advice, call them outside the board meeting. Because once you get further along and you have later stage VCs in there, people start performing for each other, like the VCs performing for the other VCs. And you don't want to go in there and ask them a question that you don't know the answer to, because they might start to think that maybe you're not the right person to do the job. I mean, Sequoia is famous for having said that they believe that half the founders they back will be fired and replaced before the company goes public or exits. And that's, those are Sequoia companies, right? That's probably the low side of that number. You don't want to be the founder that gets replaced because you didn't treat your board right. I always found there's a certain naivete among founders where when I worked for a public company and I knew the CEO and I got to see him before and after the board meeting, that's not how he treated his board, even though he had handpicked his board and none of them were major investors. He didn't go in there and be like, so what do you think I should do? Right? He would never ask that question. He would ask that question of people when they were outside of the board meeting. But in the board meeting, he was like, here's our problem. Here's what we think we should do. Here are the 3 other things that we looked at and discarded. This is what we plan to do unless you've got, a better idea. And he had done more analysis than any of the board members. So they were like, great, you know what you're doing. We trust you to do it. Our full faith is in you. And that's what you want with a board.
I think that's the right framing. I think it's management's recommendation to the board. We have a problem. There's a fork in the road. Here's the data that supports, either one of these paths that you can take. Management recommends that we should take the left, not the right, for the following reasons. Does anyone speak now or forever hold your peace?
Yeah, totally. And the best founders I've worked with were the ones who did that. The ones who got in trouble are the ones who walked in and said, we have this problem. I'm open. What do you think I should do? And usually it wasn't quite that blatant, but it was along those lines.
The other trap I see is and we've made this mistake in the past, at Eclipse, which is like everyone's a former operator. And so you lean in and try to do too much in these companies. And the reality is great founders, A, probably don't want that. B, need to build up the internal infrastructure within their own company to be able to problem solve without the need of, investors that were former operators stepping into the business. And so totally. What I look for in your guys' board meetings is very specific acute problems that we can bend the lever in your favor on, right? Some of this component stuff, right?
Yes.
We're thinking through hey, with this search firm, this is that versus that search firm to go retain, in order to go after this leadership position. Or, hey, we've got a customer that we know maps their use case maps to these 2 or 3 other customers. How can we go get a C-suite or a board level intro into those folks, right? These are high leverage moments where we can bend the odds in your favor. But that's not anybody on the Eclipse side doing the work for you.
And I think it's, VC, and I think, Seth is right. There's some things that VCs are quite good at, right? And that's things like hiring, raising more money, things that the founders and the operators don't do that often, right? I mean, there's only so many times in your life you hire a CFO. There's only so many times in your life you raise money. VCs see these things much more than founders do. So bringing them in for that kind of thing is great. I think the other thing to bring VCs in on and your board in on is, look, they only make money if you make money, or you only make money if they make money, and they want to make money. So, all right, am I going in the right direction to maximize the value of this company? and they can tell you yes or no. Like, that direction, we don't think that's going to maximize value. This direction, it probably will. And that's high level strategic. It's not like nitty gritty, operational stuff.
Yeah, interesting. And Liz, you had an anecdote in the book about a member of the board that was really former operator, if I recall, and I can't remember if it was you or Jerry's anecdote of where they were former operator that was really, Seth, to your point, like getting too hands-on, and they kind of had to be, but not out of malice. They're just like, they were just used to being an operator.
Yeah, that was me. Yeah, he had been the CEO of a company. They brought him on as an operating partner at the firm because they hoped to bring him up to be an investing partner. He was on the board with the investing partner, and every meeting he would just take over and start being like, "Okay, but here's what we need to look at." And it was as if he was the CEO, and it was frustrating because I didn't want to know what he thought. Like, I don't care what he thought because he's not in charge of the company, right? He's also not there 24/7 like the CEO was. So, he's working on a tenth of the information the CEO is working on, and the CEO was a smart guy. That's why we all invested in him. And I eventually just told him so in the board meeting, which is again just me making friends and influencing people. But he luckily for me, the investing partner, his partner, like just started to laugh because I think we all felt the same thing, which is like, okay, and the paradox was this guy was incredibly valuable. He helped the founder more than any of us when we weren't in board meetings. He would go and actually meet with customers with the founder and help close them. I mean, he was great. And I think once he kind of settled down, he's like, all right, the CEO is running this company, and I'm here to help him succeed because if he succeeds, I succeed. Then he was the best board member ever.
One of the biggest lessons in my career has been taught to me by the two of you, which is, outlier companies get created from outlier individuals that are making outlier, unique decisions on how they want their company to run and operate every single day. And if you have a boardroom that's filled with people that are kind of defaulting to the average of what they've seen drive success previously, you're by nature not, indexing towards outlier decisions that create unique company culture and unique architectural decisions and unique hiring processes and unique comp structures and all this type of stuff. Yeah, you see where I'm going here. Comp structure. But the thing that matters most is results. Like you guys are getting phenomenal results. And so like you do it your way, you play the game in the way you want to, and you succeed at a level that you're succeeding. You should be empowered to go continue to be outlier in the way you think about designing and affecting your company's day-to-day operations from the ground up.
Yeah, interesting, and appreciate that. Appreciate you supporting our various idiosyncrasies because we do get this occasionally. We're like, because like we do a lot of things differently. It's like, think about this. Like, well, they're pretty thoughtful about it. Like they take this stuff apart, and they're willing to see what we see, and they're willing to dig in. They don't.
I think that's the appreciation. Is not like a complicit, like, sure, just do whatever you're doing,
do whatever dumb thing,
or saying sorry, like this does not pattern match on where we have seen even other successful companies do certain things a certain way, but actually digging in, being like, okay, how'd you land here? Why? What was this informed by? What have you seen that's worked really well about this? What have been the challenges? And inevitably, like, how do you scale? And being there and being thoughtful about it and collaborative about it has been terrific.
But I think like what's true about you guys is in the company is your ambitions have been clear from day one.
They really have
love your customers and change computing forever. Like inherent within those values is desire to like shake the world on its axis, and you're getting those results. So the first principles thinking that informs the way you get to a conclusion around everything big and small in the company is wonderful. But the results, you guys are getting tremendous results.
Yeah. Well, Jerry, you did have, I think you were here last time, you were saying that like, look, like the company is going to completely change with what you're doing. Like, that's not like, and we may be the rare exception to that. Or if you look at our original pitch, it's like we are doing what we kind of set out to go do. But I also appreciate that we're idiosyncratic in that regard. I think that it's much more common cases that you end up with a lot more pivots on the way. And we've actually had plenty of, like, I would say, pivots below the waterline of the pitch deck. Like what we're doing is headline the same, but we've had lots and lots of ways in which the actual manifestation of this has been surprising.
Yeah, no, I invested in a business once that actually did what they said they were going to do when I met them. It was like in like 1998 or something. I just, you don't see it very often. And that's okay, right? That's what you're trying to do. I mean, if you know what has to be done before you do it, then everybody else knows too. I mean, then it's just common knowledge. So either you're the best in the world at something and you're the one who's going to win, or and you're going to have a lot of competition, or you're out there and you're actually exploring what might work by trying things, right? And that's what most founders do. So there's no problem with that. That's how it's supposed to work.
Right. Adam, what's your perspective on all this? Because I mean, you've been through all of this, and what was your takeaway on the book first of all, and what are your thoughts?
Yeah, so I founded a company, and before that, I remember sitting on a board at the company. Before that, I was invited in as I became CTO. And I remember how weird it was to sort of be brought into this. And I think that one of the things I took away from Liz and Jerry's book is just sort of further like knowing what normal is very hard for founders or folks who have only gotten an N of one or two or three to figure out like what is normal and what's aberrant. So for example, I remember in the first board meeting, the CEO took me and the new VP of engineering and really told us what to say. And it was this whole Potemkin's meeting. And I thought that was how it was. I thought that's how it was supposed to be. So I remember thinking back to this, reading their book, just thinking how useful it would be to have the perspective of like, no, this isn't normal. This is weird. Like this is a weird thing. You're being a weird act that that you all are performing for this board. Although in his defense, the board was pretty terrible and definitely did not read the materials beforehand and was going to get their pound of flesh one way or the other, whether it was useful or not. So,
yeah. So, Liz, what has been the reaction to the book? I have founders had the kind of reaction that Adam has had, like, oh, wow, thanks. Like, this is like, I didn't know that my board meetings were unusual, or I'm glad that someone else has had this experience.
They were, I'll actually just say to what Adam just said, which is that is exactly how I used to prep my executives for board meetings at my company. I wanted them to say exactly what I wanted them to say and exactly the words I wanted them to say that and not a word more because it was going to get them and then me into trouble. So, so I don't know how unusual that setup was, but
well,
I think
Liz, I would just say I think when it verges on not being particularly true was the parts that I think were potentially more aberrant, not so much the like let's stay on the message, but when the message and reality are a little bit more divergent.
It was the lies, not the
the lies, right?
Fair enough. Mine were performative at best. Fair enough.
There we go.
I think the reception has been great. The reception that I've received, I'm guessing is different than Jerry's. Founders have reached out to me through email and on LinkedIn, just saying thank you, and also asking for real operational advice, specifically during fundraisers and term sheet negotiation, with what to do in this particular situation. And believe it or not, most of the questions actually veer around, we need money, we're desperate, we have a term sheet from somebody that we hate, what should we do? That's the top question I get asked.
Brutal. And what do you, I mean, that is very familiar and like brutal. And what do you tell them?
I tell them that there are always more fish in the sea, and that as a founder, their job is to find a way forward and to survive for another day. So I try to tell them to avoid that money whenever possible. But I actually, let me ask Jerry, because I haven't asked him this in a while. Jerry, what has the reception you've gotten been lately?
It was well, I think, on the back of the book, we actually blurbed a VC that I know who was somebody I've co-invested with. And I asked if he would, we were looking for somebody to write a forward next to Sandy Lerner's because she's a founder and her forward was pretty anti-VC. and which is understandable given her history. And so I wanted a VC to write one as well in the spirit of the book, like go back and forth, right? I could not find anybody who would write one. And one VC who I knew really well, and I think he was well-intentioned, said, you should cut yourself loose from this book and from Liz. This is not going to be good for your career. Which, I was like, what career? I don't care. I'm an angel investor. I don't have a career. But but that was, nobody wanted to talk about it. No VC would agree to it. I just think, for me, that has changed a bit since then. To answer Liz's question, I think the VCs who are a little more introspective and like, let's actually listen to what a founder has to say when they're not here trying to get money from us, because that can inform, how we think about people that aren't asking us for money, right? When people ask you for money, they're going to be nice to you. Let's listen to what somebody says when they're not asking us for money, and then see what we can do better. And I think the good VCs have done that. For the most part, I think most VCs have been, dismissive of the book, at best. But yeah, so I don't know. I mean, Liz,
Actually, I was just going to say, Jerry and I, because we were getting so many questions early on, we actually created a chat bot. So if you go to founderversusinvestor.com, you can chat with the book, and you can ask me and Jerry questions. And the bots are trained on our individual voices, and we will answer you to the best of your ability.
Listeners pouring over there right now.
Just don't ask us any questions that are going to get us in trouble.
24/7.
Yeah, that's
Jerry, this is a little surprising. I mean, maybe I shouldn't be surprised, but I would just imagine that VCs would be excited about being able to look behind the curtain a little bit around some of these conflicting concerns, because I think a lot of the book is pragmatic. It's not taking. I mean, again, as I listened to the Invest Like the Best podcast, I felt, because it was my first time arriving at the content and this sort of dynamic of the two of you debating these things, and it felt a little bit more contentious. But the book is like just laying out, okay, well, why does VC exist, and what are the incentive structures in place? Namely, make your LPs, have as high returns as possible for the LPs, and to do that, you have to pick companies that are going to take big swings in big markets and be successful, and you're going to have few successes. And then, yes, different dynamics between a single partner and a partnership. And then from a founder perspective, you have an idea, then you have a presentation of an idea, and you have a narrative, and you got to get by with that until you have enough capital to get enough team and traction to prove with customers you can build a thing, and then you can scale the thing. And that a lot of times these are in lined up the same way, and sometimes they can contradict each other. But I felt like it gave a great opportunity for both founder and investor to try on the other person's shoes, and therefore be better informed the next time they are either investing or raising capital.
Sure, but as a VC, what's your main advantage in the negotiation with a founder? Isn't it the fact that you actually know what's happening and they don't?
Yeah.
I mean, seriously,
this
is true of anybody who's a middleman, right? And you traffic in information. I mean, I can go into a people company. They're like, hey, I want you to invest my company. And what do they know about what valuations are? They know what they've read in the press, which are all completely distorted, or they know, if they know other founders, what the other founders tell them. I know an awful lot, right? I mean, I see a lot of deals. I talk to a lot of VCs. They tell me about all the deals they see. I have a pretty complete feel for, in my sectors, what valuations should be. If founders come in and ask me for a valuation that's too high, I say no. If they ask me for a valuation that's too low, well, okay, I mean, I'm not too low, because if it's too low, then it doesn't work either. But it's asymmetric information. So I think part of it was that, not in valuation terms, but in terms of everything else. They would like founders to rely on their expertise.
VC who thinks you guys gave away the keys to the kingdom, and now all these founders are going to be in a better position to, I don't know, compete, is missing the forest through the trees.
Well, totally. I mean, I don't think any of those VCs actually read the book. But I mean,
that's the other thing. By the way, given the number of VCs reading board materials, I think that's probably definitely true.
Yeah, right.
Yes.
But,
Yeah.
but as an example, like there were like 3 VCs who, when they were like new and they started podcasts and they said, "Hey, you've been doing this a long time. People know your name. Will you come on my podcast? It'll boost my listeners and etc." I was like, "Yeah, I would love to do that. I'd love to come on. I mean, I love to talk about myself. So whatever. Happy to come on your podcast that nobody listens to and just talk to you because
Hey,
I want you
hey,
to
we're right here. We
succeed."
can hear you, Jerry.
Yeah. But then when we published the book, Liz and I were like, okay, what's the best way to market this book? It's not to go around to bookstores and talk to 10 people in, every city in the country. It's to get on a podcast where, several thousand people are listening. I asked those 3 VCs, like, hey, would you have me back on your podcast so we could talk about this book? And they said, no.
Oh, wow.
And I mean, those 3 people are
yeah.
dead to me now, but
Absolutely. Yeah, absolutely.
But I mean, it's just the cowardice,
Yeah.
Yes.
Yeah, it is.
I don't know,
Yeah, Seth, go ahead. Yeah.
I think what I always try to remember is like it's humans on the other side of the table in all of this, right? I tell at Eclipse, we invest in a lot of companies where like they work with regulators, right? And like I tell companies all the time, like, hey, regulators are people too, right? Like they've got a job, they're good and decent humans, they're not standing in the way of like technology because they're Luddites, so to speak. Not all the time. They have a job to do. I want people at the NRC and the FAA and the FDA to do the best job as possible, and like our job as company builders is to go engage with them, earnestly. I think there's in this dynamic, like one of the things that we talk about a lot at Eclipse is like every single founder that walks in our proverbial door had this moment where they laid in bed either by themselves or next to their significant other and said like, fuck it, I'm going all in. And like that is a sacred thing. And we do 10 deals a year, but to Jerry's point, I guess everybody sees thousands of deals a year, but like we're not going to do every single thing we see. And I think like that's really important for VCs to remember. But on the flip side, we take money. I want to tell you about an organization that we take money with. I won't name the organization, but it's one of the top institutional LPs in the world. Their whole mission is to endow 2 pediatric hospitals in the United States and to fund 2 things: the capital projects that have 0 ROI, bone marrow transplant facilities for pediatric, for treatment of children that will never make money on that. And to live the mission of the 2 organizations, which is one more child. Never turn away a kid that needs healthcare treatment because of money. Like that's who I work for.
Yeah.
And like that's what I try to keep in mind. And so that means that I'm in stewardship to that capital, and I take that really seriously. So I think like founders need to be like not all funds are that type of institutional LP, and we certainly have a range, but like every single check that I write, every single check that my partners and I write is in stewardship to that mission. And you have to take that super seriously.
Yeah. And I mean, I do feel that, and I feel, Seth, it's just important, and as you're saying that at the top, it's a voice that I think, because that founders don't often hear, but we hear the kind of the loudmouths that are shooting their mouths off on social media or what have you, and who aren't talking about that. And I think that sometimes the quieter voices are the ones that are felt much more deeply. And I think that there are the good ones out there. I think it's really, and good founders too, right? There are, it's a challenge to find one another. And this mating process between great founders and great investors is messy. But it is very important to remember that like the others do exist. And that you've got, and that Liz, I just feel for like the companies that are like, in order to keep my company alive, I have to take money from someone who I hate. Would be, God, that's what an awful situation to be in. And I mean, we've been blessed that we've had the luxury of not having that, but I think it's our job to make sure we're never in that kind of a situation. Because that is so, I just feel for the founders that are in that kind of a situation. This has been really terrific to have you on. Actually, may I call out one other VC anti-pattern before we leave? One, exactly. Okay, did everyone get exactly one? So I'm going to call this like day late and a dollar short. We've had a couple of firms around Oxide that are super interested. First of all, we get this a lot. We get firms that are super interested, and we get a potential investors like, I just do not want to waste any of your time. And we're like, okay, like that's great. So
what are you guys doing for the next 2 hours?
Yeah, what are you guys doing after this? I'm like, what do you mean? What are you doing after this? Go after we leave. Like, what are you guys gonna do? I'm like, we're gonna go do work. What are you talking about? What are you having this? Like, you're wasting my time. Right? The thing that you said you weren't gonna do in the previous sentence, you're now doing in the next sentence. But we've had a couple firms that are like super interested, and then they're always not getting over the line. And they're always at like the wrong stage. I mean, we've got the blessing of things are really tacking in a very positive direction. And you're just like, could you just leave us alone, please?
Well, the wrong stage in both directions. So it'd be, wrong stage because they're a growth stage investor that really wants to go earlier.
Yeah.
Maybe because they're getting their lunch eaten by bigger growth stage investors. And like the place to go is earlier. And so they're like, yeah, no, we want to go way earlier. And then they're like, yeah, every portfolio in your company is software only. We are software and hardware.
Right.
Is that a problem? They're like, we totally want to get into hardware too. And you're like, I honor that. That's great. You're trying on a lot right now. Or the other way where it will be, gosh, if the company just had one more enterprise deal, we'd be over the line.
Well, and you should retell a great story. They were complaining to Pierre. A potential investor was complaining to Pierre. It's like, God, if they only had one more commercial deal.
Yeah. And Pierre, as he is wont to do, got together with the entirety of that partnership and said, I think in his words, gentlemen, you want one more enterprise deal. I want one more enterprise deal. If we all had a bunch more enterprise deals, this wouldn't be early stage. And left them just kind of,
looking at wounds from a 93-year-old or whatever he was at the time. Yeah, exactly.
But again, and then when the time is right, and it's like, oh wow, wait a minute, you've got many more than one more enterprise deal. I'm now feeling less scared about this opportunity. This is less risky. Then it's like, but I've got ownership targets. I need at least 15% of the company. And you're like, oh. I had to hear that, but like that train has left the station.
It has left the station. I know you can't have it both ways. You got to be. Come on.
Mine were much more pedantic. I wanted to say, Liz, thank you so much for talking about asking founders to eat legal fees in docs. I know it's stupid. It's small. It's enraging. It is like, come on, you really want us to pay for this large trough that surely is going to get eaten all the way through. It's like, oh, the fees came in, $2,112 underneath what the previously arranged number was, and that one always just sticks in my craw. And unlike
you can rely on Steve to redline the number. We're going to take this number down.
But you're just wrong there. I mean, it's their, they're paying with their own, you're paying with their money, right? So
I pay you with your own money.
You could cap it, or you could ask them for more money to pay for it. But I mean, I lead deals, but I can't write all the money. I can't write checks for the whole round. So if I pay for the legal fees, how am I going to get it back from the other investors? There's just no way to organize that.
Tell him, Jerry.
Liz.
Yeah, exactly. Finally, it's what grates on you is the specific number.
Yes, because unlike like the numbers that we've seen are much larger than, and it's just like, and then you see like in-house counsel, outside counsel, like all these lawyers start showing up, and then inevitably everyone wants to take apart tiny little terms that don't really matter, and before you actually spend a big number.
Cap it at like 25K. They can get the deal done for that. They can get the deal done for that. There's no question.
I think we're not going to be specific with the numbers, but let's just say that capping it at 25K would be the kind of red line that Steve would go back to, because it was not capped at 25K.
And that would be, shocking.
That would be shocking. That would be like, are you kidding me? So yes.
No, I mean, again, I think like one of my reading the book and also listening to the podcast, it's just like there are little things that trip up both sides that leave both sides assuming ill intent in places where there isn't. And if we could clear out a bunch of that stuff, I think there is a bunch more alignment, or at least there's a cleaner path to the right investor and the right founder matching up faster.
Yeah.
And, I don't know the best way to get there, but it is the other thing that would be just so helpful for founders is to get a little bit more transparency around partnership dynamics.
Yeah.
Like, it's fine if there is someone in the partnership that just fundamentally doesn't believe in the company, but knowing that and knowing that they hold a lot of sway in the partnership earlier in the process just saves everyone a whole bunch of brain damage.
Yeah, but Steve, isn't that like, well, we had a good first date, but I will tell you, my mom hates you. So I think this could still go somewhere.
If your mom hates me, this is going to be.
This is not going to work out.
Even if it does over the line, it's going to end poorly.
It's like it's much better than like, listen, there's a check the box meeting with my mother. Don't worry, it's a check the box meeting. It's like, why have the meeting if it's a check the box meeting?
And if you have to fight your mom to drag me over the line, I promise you, this is not going to be long-term successful. But yes, I understand people are remiss on, because they want to, everyone wants to preserve optionality. Problem. Like, they want to, like, you got to stay in the broadest part of the dating pool as long as possible until.
Right. I'm just not going to mention my mother. Like, my mother says no to everybody. So let's get it all the way over the line first.
But I do think, to Seth's point earlier, it's like it's so amazing when you find the right investor and you feel like you've got someone who is as big a believer in the company and the long-term strategy and is going to kind of be seaworthy in times of good and bad. And, I'm sure vice versa from an investor perspective when you match up with the right founder. And so I think the book does a service towards getting that matchmaking to be a bit easier.
Yeah, I think it's a huge service. So thank you very much, Liz and Jerry, for the book, for both being willing to. Jerry, thank you for sacrificing your non-career, apparently, for the benefit of us all. But
I've done okay.
Exactly. Really, I think it's a huge service, and I think everyone should read it. I think founders and investors should read it, and you should listen to it. You don't need to. Not everything about it is gonna. That the whole point of it is that you're getting two different points of view, and you should make up your own mind and you're going to agree with some of it and disagree with some of it, but it's an important book.
And bonus, if you listen to it, it's actually Liz and I reading the book too. So it's our voices.
That's awesome. Seth, did you cut it on audio? That's great. Yeah,
I will say to that point, Jerry, there is a little bit of a cadence mismatch there. So like it does make it difficult at times to be at 1.5x or 0.2x on the audio.
Oh, you can't listen to me at 1.5x. That's not
you're
listenable
at 1.5x, 1.7. That's difficult.
I tried to talk more slowly when I was doing the book. Really tried very hard.
Good listen.
Awesome. Well, thank you both for joining us. Seth, thank you for joining us as well. And thanks, Seth. Again, I know that we have not been able to publicly call you out until now, but thank you so much for you and the firm's belief in us, especially at our Series A, and really more than compensating for some of the bad behavior out there with really terrific behavior. Thank you very much.
Thanks for making me look good with all of your execution over the last few years.
That's it. Actually, it does feel great to actually vindicate the belief that people have in us. Now we need to go keep it. Now we've got actually lots to go do to get back to work to keep vindicating it. So plenty to go do. A long way to go, as always. But awesome. Thank you very much, and thank you for joining us at the off time. We will be back next week. We're going to hit you up at 9 a.m. actually Pacific time because we're going to Europe friendly. We got a good one to talk about. An 18-year-old bug that is that we recently resolved that we're going to have fun talking about. So
yeah, should be good.
Awesome. Thanks everybody. See you next time.